Hello everyone. Hopefully you have already given our practice problem, cash flow statement, a try, and now you're looking to make any corrections or check your work, see if you uh, understood it and got it to work properly. So you were given this information here on the left side of our screen, an income statement, and then two balance sheets, or two balance sheets and then the income statement, however you want to look at it. That was given to you. So using our pattern, first thing we need to do with a cash flow statement, to create a cash flow statement, is to calculate the change in cash. That's our ultimately our answer. We need to explain the change in cash. So here's our cash at the end of the year, end of 2025, and here it is at the beginning of 2025 or the end of 2024. The difference here, you can see the easiest way to set this up is just to put it in a spreadsheet. Okay, calculate the difference, 367. That's our change in cash. All right, so that's where we're headed. So starting with operations, we're going to use again the indirect method. So we need net income from the income statement. There it is. And here it is in our starting point of our cash flow statement or operating section. Then we add back non-cash expenses. So we find depreciation and amortization. We could have named it that. I think it's both on the income statement. Now, sometimes it'll be separate, and so we'd have two, but depreciation expense added. All right. Now, there's an impairment for 186. That is an impairment of property and equipment. Technically, that, depending on how you look at that, some people would consider that a loss, similar to gains and losses of our next section. Others would consider that a non-cash expense. The reality is it's really, it can be either one. It's going to be used in the same basic section, in the operating section, so no one's going to worry too much whether it's which one of those two it is. Happens the same way. But we're going to add that back. If it's a non-cash expense, we're adding it back there. If it's a loss, we're adding it. Okay. We also add the loss on sale. Remember, at this stage on the operating section, we're not worried about the detail about how we got there. We just need to know that we're going to add it back. So we added both the impairment and the loss on sale as the next section. Then we jump into the changes in our operating assets and liabilities, making the assumption that current assets and current liabilities are our operating ones. We set up a balance sheet side by side, calculate the difference. We see that merchandise inventory is our first. Okay, we can just shorten that. I've shortened that inventory. Calculate the difference, 243. It's going down. A reduction in an asset means cash is a positive. It's a positive cash inflow. Prepaid goes up. That means we spent money on it. That's a negative. We got the 87. Set up the formula there to calculate the difference. That's our current assets. We're not going to work with the total at all, right? We work with each one separately. We already considered cash because that's what we're explaining. So the other current assets, not a lot, just two. Okay, jumping down to current liabilities. We got accounts payable. The difference is 296. It's going up. An increase in liability means we have more cash. Accrued liabilities, same way, not as much, $20. So we have both those accounts payable. Notice I haven't put increase or decrease. Okay, we can go back to that and fix that before we submit it to our readers and produce an actual financial statement. But for now, we're just labeling accounts payable, accrued liabilities. Okay, interest payable, only a change of 2, and income taxes payable. Okay, change of 18 goes down. We paid it, so that's and like our example in our reading, there's also deferred income taxes, which has to do with operations. It's an operating liability, even though it's long-term, violates our general rule, but that's why we have to have this information. Deferred income taxes, 15 up, so that's an increase in cash, borrow more money, if you will. So our cash from operating activities, adding these all up, 2163. All right, that's our first subtotal and probably the most important one. Remember, that is key to our financial health. Now we get down to the investing section. The easy part is the cash we received on the sale given to us here. All we're worried about in this section, remember in the operating section, we're just worried about the gain or loss. This section, okay, at least at this point, for this disclosure, all we need to know is that it's $19 in cash, 19 million, 19,000, whatever. Okay, so that's goes there. Cash received, other assets. While we're there, we had a change of 2. Doesn't sound like there's enough to worry about changes on either side, that sort of thing. So we're just going to put other assets as a long-term asset. It goes under investing is the assumption we're going to make there. Not enough to make a whole lot of difference. Now, property, plant, and equipment is the confusing one on this example. Okay, so we know from our cash received or this loss on equipment, okay, our assets, that we sold something. So there, what we would expect is that it to go down. We also would expect, because we're using on the balance sheet our net property and equipment, that it would go down because of depreciation. So that means that we've already subtracted out accumulated depreciation. So every year, absent, that we buy new assets, it's just going to keep dropping the net. So we're going to build ourselves a little model here to figure out what the change of net property, plant, and equipment is. You can do this as a T account. You can do this just as a calculation. So we started the year at 8308. We expected there to be accumulated depreciation, or the same as depreciation expense, pulled from the income statement, right? Okay, and we're just going to lump all those assets together that have amortization as well. Okay, so that would mean that without any other change, there would be 7370. But there was the impairment. That means that the value of the assets went down. We'll study that a little bit more in a later week. But for now, we just need to know that that made the asset go down, those property and equipment assets. So we're going to subtract that. All right. And then we know that we sold assets that had a book value of 35. We're using book value, so don't need to worry about separating the accumulated depreciation out from the original cost. We just subtracted 35. So the question mark is this 954. How did we have that? Well, this is a total that we just subtract that. And if we took this out, say we made that 0, then our little formula here is going to say that we would end up with assets, given what we do know. The part that we don't know is the purchase of the assets. Given what we do know, we would have ending assets of 7149, and we have 8103. The difference, all right, is that 947. Whoops, 950. There we go, 954, I should say. All right, and literally we could have just plugged numbers in there until we got it right, as long as we have our formula set up. Okay, so put into your T account or to your all the pieces you do know from earlier or given in the information, and then the number that makes it all work, it has to be the cash paid for assets. So that 954 then becomes our all-important number paid for property, plant, and equipment under investing. So total investing, okay, is 937. Subtotal negative. That's kind of cash outflow. That's what our expectation, that we don't consider that a tremendous problem. It's probably a good sign. All right. So let's go down to the financing section. We're looking at liabilities and equity. Just like in our earlier example, maybe we'll take on equity first because it's a little easier. Treasury stock changed by 569. Okay, just take the difference. 569 it's more negative. That means we bought more treasury stocks. That means we spent cash. You literally can't buy treasury stock without using cash. It's actually against the law. Okay, dividends paid. How did we get that? So our retained earnings should go up by the amount of net income, but it didn't. It only went up less than 200, and our net income is the 556. So there must be something that reduced how much it went up, and that is always dividends. So you figure out the difference between what it went up and the net income, and it's 360. And then the sale of stock. Common stock didn't change at all, okay, because it's such a small par value and it's rounded so much that we can't even see the change. Okay, it probably did, but it's so small as to be rounded off. So we look at paid-in capital because these two really go together, and we see that it went up 56 plus 3, 59. So we must have sold that for cash. Cash come in from the sale of stock. If we want to be fancy, we can put in cash received from the sale of stock, something like that, 59. Okay. So that is the equity part. Now, something interesting, okay, we notice no change in long-term debt. So no new borrowing there and no payments. Okay, so we can check that off as considered, but without any change. There's nothing listed on our cash flow. Other long-term liabilities changed, and because it's other and we don't have much detail about that, we can just look at the difference, okay, of other long-term liabilities, 138. If you look at that, that's exactly what the difference is between those two. It went up, so it's a cash inflow. And then the payment on capital leases. There's some interesting there. Here's, in another example, we have the current portion of long-term debt and long-term debt. This example has current portion of capital leases and the long-term capital leases. Okay, so we're going to treat them together just like we did before. We're going to look at this plus this and compare it to this plus this. And what we find is the difference between the two totals is 127, which is exactly what we paid according to this little note, and what we would expect is to pay the current portion of last year's. So that we have verification that we paid it all. So that's why the payment on capital leases is 127. That is the capital lease part that was paid. And we have two pieces of information that tell us that, this little note and the 127 for current portion. So add those up, we get a cash used in financing. We check ourselves, we take cash from operating, cash used in investing, cash used in financing. All right, and we get 367 changing cash. And then we do this little reconciliation, is often done, where we take the changing cash, we take our beginning cash from the balance sheet, 707, add those together and get ending cash, just to prove that we have done our job and explain the changing cash. There are no significant non-cash financing or investing disclosures, but our cash paid for taxes would be 337, okay, which is the income tax expense from the balance sheet, I mean the income statement, okay, add to it the change in taxes payable, because the taxes payable actually went down, right? So we paid more. And the formula you can actually see there. And cash paid for interest, same thing. Take the interest expense and then adjust for the change in interest payable, which is only $2 up here. Notice that, okay? So those are your required disclosures. So you've got a cash flow statement. You can go back in, put some more explanation, like you can break these into the 3 sections. You can put that this was a decrease in inventory, an increase in prepaid, the sort of thing was often done. You can put a little more description, cash paid for dividends, especially if there were some stock dividends or other types of dividends. Okay, cash paid for treasury stock, maybe to make this a little clearer. And you're ready to have a cash flow statement ready to send out to investors. All right.